Good morning, traders and investors around the world. Welcome to this Monday, September 20th, post-expiration edition of Pre-Market Prep with StockOdds. Joel Elconin joining you here with Mr. Rob Friesen on what has turned out to be a volatile Monday morning, kind of kicked off by a volatile Friday close, Friday after hours, Sunday night pre-market. But whatever you have the S&P futures down at 69 handles at 43.53.75. Pre-market high, couldn't even get to that close of 44.21.75. Was hoping to see that. Nope, got turned back at 44.18. Pre-market low, 43.40. That's being protected as we speak with the low at 44 and a quarter. Having a hard time, easy time getting away from that off the open. A little bit harder time now as we just dropped another 3 or 4 handles. Taking a look at the crude market, crude oil futures down $1.41, flirted with 73 yesterday, now banging on the door of 70. We'll keep an eye on that current low, 69.81. You had a low from last week, last Tuesday at 69.74. Big level for crude oil futures. Gold doing what gold's supposed to do, act as a flight to quality, flight to safety today. We talked about the futures getting over the high from Friday at 1767.80. Well, it got to 67.10, currently trading up $14 at 1776.40. Silver, new low for the move, but back green now, up 6 cents at 4 cents at 22.39. Bitcoin being treated like an equity today, trading down $3,685 and 43,805. Ethereum taking a little bit more on the chin. That's down 10.6%, $363 at 3,062.75. Mr. Friesen, we deal with down opens. We deal with up opens, and we deal with flat opens. Talk to us a little bit about dealing with the big down open. Do you try and stick with your stock odds? You try and go with some technical levels? Tell you how you approach that ugly opening this morning.
I'm in 182 longs and 65 shorts, and my shorts are still, the thing is, you had to put some restraint on how you get filled on the open, because some of the stocks were down 7%, 8%, 9%. Do you really want to be shorting them down there? So, the advantage goes to buying the discount. So, but with my shorts, I am more green than both my longs and my shorts are green. But the thing is, the shorts are more green. So it would have been nice to have, more shorts in the mix. But the SPY takes its place. Another choice is IWM. Another choice is diamonds. But the thing is, with a down day, the Dow is usually a little bit more defensive than the SPY or the IWM. So it doesn't warrant me to short the diamonds because it's not going to go down as much as some of the symbols. So the best alternative is still throwing some spider in short to make up the difference. But it's just an interesting day where you can go in and sort of listen to the backdrop of banter out there, like it's going to be down further, this Evergrande thing is a big deal and all that. And yeah, it's not finished, but this isn't the first day it's been in the works.
It's true. Yeah. We talked about this last week. Yep.
So we've had seasonality. We expected Friday to be down as it was. It was pretty much bang on with our almanac. And then the question is, where did Friday finish? And so Friday finished by taking out that wonderful trend line that everybody was so magically drawing on the screen. And we took it out. And so the question is that going to bring in some more sellers that are concerned? So when you have a bad Friday and then you look at after hours, it sold off a little bit more. Then you anticipate that it possibly could carry over to the Monday, right? That's happened many times in history. This is not the first time. So because of the way that things closed at the end of the week and that down Friday, we had a lot more longs generated than shorts. That's one of the products of things moving that much. It's like, for example, Joel, if something had only had that type of move that it had on Friday, maybe in the last 10 years, it's only done it 12 times, like Electronic Arts, for example. It could argue that since it's only done it 12 times, that's not that often of an event. So the question is, what does it do afterwards, right? And if your numbers are saying every time it's done it in the past 10 years, it's come out of it really well, then you're going to stick with your data, right? Like, why would you argue with it? So the thing is, I took the 182 longs, took the 65 shorts and didn't argue. And so, the day is going along really well. Those longs got filled at a discount. The SPY, I just did them at the same time. So the SPY sold off right after the open, just relieving some of that pressure, I think, as people were needing to get hedged. And then it bounced back. So, nothing to do for the rest of the day if I don't want to. I just leave it to the close, or, I can get in there and try to optimize it if I want. But the VIX.
So you had to offset. So you had more long dollars out there than short dollars, correct?
Yeah,
just initially, right?
By 3 times.
Okay. So
but no, I mean, I did the SPY at the same time, so
okay.
I was balanced. My point is, though, if you think about it from this perspective, what's going to give you better bang for your buck? Being in a $12 stock that has 95 volatility, or the SPY?
SPY.
No, the stock. If you're buy a stock,
I'm talking for the head. Okay.
No, but what's going to give you better bang for your buck in terms of making money? The whole point is that we want to make money, right? So if you have a nice down open on a stock that has a high volatility,
okay,
right? If it's already opening down, then you can get a slingshot. Where a lot of people make a mistake in trying to say buy the dips or buy these discounts is they're not thinking hedged orientated. So what happens is they buy that open, right? Or they buy pre-market, or they buy just after the open, and then everything tanks and they get kicked out of the trade. And later on, about 2 hours later, they're like, oh man, I knew it, right? And they're kicked out of it. The whole point is, if you learn how to hedge, if you have a lot of ideas to draw on from the hedge side, you won't get kicked out of these things, right? You'll be in there for it to come back. So what I expect is overall, if the market, even if it goes down lower, is that the long stocks are still going to hold up better than the short, right? So that relationship is going to come together. So it's already nicely green. It'll probably continue as the day goes on to contract more. So the long dollars slightly outperform the short dollars, and it comes together. And it really doesn't matter if the market goes down further or goes up or whatever. Now, here's the beautiful thing. Let's just say that we get that capitulation, say by between 11 and 11:30 Eastern time, right? When there's some margin calls that come through. They usually have to be done before noon. So let's say there's some margin calls. Let's say some people throw the towel in and we have another down session, and we get that capitulatory event where it's down and high volume and people are getting flushed out. And then we start to turn around. So let's say on the SPY, you get a nice hammer, right? On the technical chart, right? You get a nice hammer, good volume flush out, and it starts to turn. And the next bar is up. and the next bar's up, right? All I have to do is buy in some of that short side of the SPY, right? And guess what? Now I've created an imbalance in the sense that I have way more long dollars than short dollars, and let her rip. But I wouldn't do that unless you get really good confirmation. It's like, let the house, let the house show you their cards, right? Let the market go first, and then you can go with that.
And so on today, like a day when you just did things right off the open, that was a good thing because you had, wherever the opening, the S&Ps had a pretty quick drop right after the open, like 10 handles. So if there was an instance where you waited on that as opposed to the open, you could have put it on in the hole. So it's just, I guess the point I'm trying to get across is that, when there's this excess volatility, in the market, which we have, better instance to go at the open, get the opening price, get the same time your stocks are executed, as
get
opposed
to
get the hedge on.
And the thing is, right as it was getting filled, like what happens is some stocks were filled like even 5 minutes after the open. Like you don't get everything right away,
right? Yeah.
Okay, so that there's this delay. So the thing is, you don't fully hedge anyway. Like the point is, like you're not going to know exactly what you're getting filled on if you're using limit orders. You're gonna be pretty close. If you're using market orders, you still have that delay. So it's never perfect, but here's the thing, even if my long dollars and short dollars were equally balanced, my fingers on the trigger of the SPY, let's say, so that if the market just suddenly, confirmed that, hey, that was a great discount open and it's starting to shoot up, I could just buy in some of the SPY instantly, boom, and let the stocks run. So you're always loaded, ready to go, right? It's about being responsive as quickly as possible. So here's the big point. You can listen to the talking heads. You can, you can be fearful about, what's going on and all the concerns, or you can really just live in the research and the data that you'd already did, and then you just check the pre-market stuff. So we saw what happened Friday after hours. We saw when the futures opened on Sunday, and we saw, what kind of took place there. We knew that the trend line had been broken. We knew that things didn't really bounce that much. So that just infers that it is softer. And you have to prepare for this. You got to say, it could open on Monday and continue to get really bad. It could also open really bad and bounce. So both scenarios have to be planned for. And that's what you are as a trader, is really a emergency, management personnel running the scenarios of what happens if there's an earthquake in your city. What happens if there's, a disaster, a flood? What do you do? What are the scenarios? That's what you do as a trader. You run scenarios ahead of time. So one of my scenarios was for the day to get really bad. Another scenario is for the day to bounce. Those two simple scenarios are not hard to figure out what you want to do. What do you want to do if it's going to bounce? Well, you want, generally to be prepared to have more long dollars working, or to be in, some of the higher volatility, more risk on type of instruments. And the other one would be more defensive. So as it was this morning, I looked at this on my screen. I'll share the screen here.
Sure.
So that's just a snapshot of some of the ETFs that are just on my watch list there this morning. So you can see that the VIX the VXX is up, which By the way, the VIX that tracks is pretty much at our July highs. So the next stop is the May high, which is in the 27 range, right? So we're at 24.45 right now. So 27 would be the next stop. Remember that once this thing plays itself out and we get the, that final hurrah on the volatility, remember it decays very rapidly after that. And so this instrument here, VXX, becomes a pretty good short once you get that capitulatory event. I don't know if it's going to come today, tomorrow, or sometime this week. I don't know. But once you get it, remember it decays pretty quickly. Our volatility periods are very short-lived, okay? So the other thing we notice is TLT. So Thursday, the US dollar was up significantly. Friday, it was up significantly. So we see a flight to quality, in a sense, a defensive posture. That means that it affects commodities negatively, right? Most commodities like silver and gold were being affected. However, last week on Thursday, Friday, oil was still tracking higher. And so therefore it was a bit stronger. This morning we come in and we see oil opening down. So I had some oil stocks for today. I left them in as longs just because. So I'm looking at it two ways. So I'm looking at this whole thing as, what is it telling me? And it's telling me it's defensive. Let's look at this. XLV, okay, healthcare is more defensive. Consumer staples, more defensive. Sorry. XLU, more defensive, right? So TLT would mean that the banks and the utilities would be more favored. As you can see, that utilities were down less. So these ones that were down less are more defensive. The SPACs obviously getting whacked, and a lot of those more speculative names that the SPACs indicated, even ARC Genomics getting crunched this morning. Now the financials were down, but because of the TLT being up, I wouldn't be too concerned about the money-centered banks. They might be attractive to me. Other financials, I might not be that interested in, but nonetheless, a good discount. So you're looking at it this way. What's super discounted that could slingshot back? But also, what is it telling me about the posture of the market? Okay. So here's kind of what I did too, is that after we had that SPY bounce back this morning, we sold off first and we came back. I noticed my dollars still weren't, so I shorted more SPY and I over shorted it. So then I went in and I bought the diamonds against it. So I actually have my list of stocks, plus I have a little more SPY short and more diamonds long. Well, diamonds are defensive. As we mentioned earlier, right?
Today, yep.
So it's fine. I mean, it's and that gives me more to work with. Like if the market starts selling off, I can sell some of the diamonds and benefit from a crutch trade there. We're going to talk about the crutch trade at you said October 16th or something.
Yes,
is the
correct.
class?
Yep.
Right.
Yep.
So we're going to talk about some crutch trading things. So I have the ability to do this. Either remove some of the short on the SPY if we rally significantly, or sell some of the diamonds if we go down. So I've got that kind of like, push pull, gas pedal. I mean, again, I've used this analogy before of you're mowing the greens with one of those nice, tractors that you have you pull and it turns, right? So those are two levers that I can pull, either diamonds or SPYs. I won't do much with the symbols. The symbols are fine. Everything's working good there. Give you an idea.
So you're talking about besides your hedge positions, taking a hedge against your SPY then, right? So you were talking about adding another layer there?
Yeah, well, I'm long the diamonds, right? And I'm short the SPY. SPY's down 1.48% right now. Diamonds are down 1.38. So they're a little bit less,
Right.
right. NASDAQ's down 1.88. So if that was going to come back, if it was going to do a comeback tour today, that's the one that's down the most. And run the Russell as well, down 2.24. So, I mean, either of those might be attractive from a buy the discount opportunity if the things are going to come back. But this is the safest one to be long while we're in a defensive posture. So we're not out of the woods yet. We'll have to see what, we kind of gone sideways now and we're pretty stable, but we're not out of the woods. So we'll see if there's another round of selling or if we want to rally back. If we want to rally back, your edge for, comeback tour goes to these two, the NASDAQ or the Russell. But, like I said, I have diamonds and SPY in a posture right now that I'm long the diamonds and I'm short the SPY. Again,
Jamie's asking, how do you confirm and avoid whipsaws when making these adjustments?
Well, don't do a full position at one time. Meter it out. And here's the thing: the market kind of come to you as well. So here's what happens with people when they're trading the SPY. So let's put that in there like this. Just go to the chart here. So when you're trading the SPY, and by the way, if any of you guys are using FinViz charts, even if it says 1 minute, they're really slow compared to data. Like, so you're probably at about a 10 to 15 second delay actually on these. So you can't use a 1 minute chart on FinViz or something for actually trading because you're going to be late. But here's the thing. You can use it for reference. That's what I do. They're all my reference charts. But so if this is suddenly like, starts climbing right up to here, like it's like, I'm going to buy it, and you buy the SPY in a full position, it'll probably pull back on you. Whereas if you do this, you go, if this thing drops down to this level, I'm going to buy some, and you kind of meter it. You put a few different levels in there. That's much safer way of getting the SPY on. The same thing on the short side. Look at your levels. I would put some short out here in front of, the last high that it had and see if you can get short. So again, the worst decisions come when you see it moving, it's already moving, and then you go. It's much better to sort of be a scale trader and you're there ahead of time and it comes to you. But that means that you have to break your size down into smaller, more manageable pieces, because if you get filled, it could keep on going a little bit, right? So you don't want a full position. Make sense?
Yep.
Just meter it out. Just be a scale trader. It's easy to be a scale trader around. We can talk about that more on the Saturday too. Around the, you have a portfolio already on. You have long dollars, you've got short dollars, and you're just making incremental adjustments. It's easier to be a scale trader. Okay, so I want to show something on those people that are looking at maybe lining up the ducks. Just an easy way to do it. So let's say that you want to curate something for %B, and you run your Explore here. You come up with a bunch of symbols that you want to trade for the day. So let's just say we sort this by, I'll just make this a bit bigger here. We'll sort this by odds. And we say, okay, there's electronic arts, whatever. I want to take these ones long here, right?
Okay.
There's other things to look at, but we'll just, for the moment, we'll just take that list, go back to your screener here, pop it in the symbols category here, and save the changes. And then go to your RSI to, let's say you want to use that and explore that. And now you've got a whole different list here. So those were the symbols that I popped in, and then I can do the same thing again. And this is really just a simple approach, but let's say I even did the same thing and sorted it by odds. You would see that They all fit. So the ducks line up pretty well. I could do the same thing with average performance. Here's something that has a negative. I'll put that out of there. Oops. Right? I don't want negative performance, even if the odds are good. Just means that it's not helpful. That one's fine. Oops. Anyway, you get the point. So this one here is got negative average performance. This one has negative average performance. This one has negative average performance. So wouldn't include them. But nonetheless, well, the percent B screen seemed to align here with the RSI for the most part, except for a few symbols. And that's the quick and easy way to do what I do with lining up the ducks, is just take one of your favorite screens, take the symbols that you would want to use, but then take those and put them in another screen and run it again and see what you get. Filter again. If you want to do another duck, take the remaining symbols, put them in again, run it, and you've got your 3 ducks. Meaning the symbols that are left agreed on all 3 of your indicators. So it's an easy way to get some ducks. So that's what I'm doing today is the longs that I have multiple ducks. So at least 2 of 3 ducks line up.
Okay.
And that just, they're just robust, very robust longs. And my shorts, had highly favored to go down and perform worse than the rest of the stuff. So if you take the Russell 3000, for example, the shorts are the ones that said overall they're going to perform poorly, and the longs are the ones that have said overall they're going to perform better. Well, you just put them together. And in a perfect world, your shorts go down and your longs go up. And right now, my shorts are ahead of my longs by a little bit. But it's pretty balanced. The longs are making money and the shorts are making money. The shorts are going down, the longs are going up. So they're both making money. It doesn't always happen. But today it is happening, partly because volatility's increased and generally traders make more money when they're tired.
Right. More indecision out there. Eric has a question for you. Do you zoom into the 1 minute to time your SPY entries, or what time frame do you use to zoom in for your SPY entries?
Yeah, I mean, I use a 1 minute chart, but as I was saying, if you try to time it by using FinViz, nothing to discredit FinViz. I mean, they're good in a lot of different ways, except that the chart is slightly behind the real market by about 10 to 15 seconds, which is a lifetime if you're trying to get really good positions on. So just so you know.
Okay. All right. There is we'll wrap it up here with just one stock here to take a look at this morning. I'll just look at it. Why don't you release a chart and I'll take a look at it technically, and then you could say take a look at StockOdds over the next couple days to see at least what the 3-day outlook is. And that stock is Tesla, TSLA. I will share my chart and bring it up, take a look for you. And then Rob could do it. Tesla, always in the news, always having momentum going one way or another. And boom, gap down today. I don't know if that was, that's probably in sympathy with the market. Man, oh man, I don't like the gap down. So if you're shorting this thing and you're looking for 700, you could get squeezed here if it tries to fill that gap between, what do we have? Between it's not that big of a gap. 742 to 750, currently trading 725.80. I don't know. Next daily low for me comes in at 708.85. So that would be a target for today on the downside. Current low is well above that 725.55. But I think if you're waiting for a straight shot down to 700, I think you're going to have to, regardless of what the market does, may take some heat on this one above yesterday's high. Rob, you have anything on StockOdds for Tesla? Because I mean, going into the trade from Friday, it had a good day Friday and a strong market. So I'm sure I like to see what the odds said for today and also the 3-day outlook.
Yeah, well, the open to close today was pretty benign for
Okay.
Tesla. The odds were actually 47.9. That was under 50 for the
Yeah,
open.
okay.
Not much change in performance though, so it wasn't screaming, "Hey, I want to short it at the open." But for the 3-day, the odds are positive, which means that that's the going from the close of Friday to the close of Wednesday. So in the light of that, it has a real opportunity to turn around and come back. So it could be a great buying opportunity at some point. But here's the thing: is that so now we're starting to get back to test the low of the day here. If we break and we continue to go down, it's going to pull some of these stocks down. If you want to look at FinViz, for example, has the groups that you can look at and by capitalization. And so over the last month, we've seen the large caps and the mega caps really underperform the other stuff. We also saw that on the 1 week prior to today. So today, the large caps and the mega caps have been holding up, but the trend over the last month is that they were taking it on the chin, including the NASDAQ 100 finally started to falter, right? Because it's been stronger than the rest of the stuff all summer. So what we've seen is that there's been a bit of a risk appetite for small cap, micro cap, and nano cap this last couple of weeks here. So they've held up in this down September better than the other stuff, which is unusual because normally small caps don't really kick in until November, right? That's when we get like IWM, its performance for November is over 5% historically. So we have a real unusual circumstance here in September where they seem to still be gravitating towards these smaller caps. Today is an exception in the sense that it's the first day out of all of September so far that I've seen the small caps performing worse than the large and the mega cap. So it might be because some of the value, some of the flight to quality is holding up a little bit better. I think I read the day correctly, which was, be defensive, which is why, like I said, when I wanted to work at balancing the capital out a little better, I bought some diamonds against the extra short I had on the SPY. So that's kind of my posture today is
Okay.
So I left the utilities on long. I mean, it's like looking at all my longs for this morning: utilities, money-centered banks, healthcare, things like that. I didn't steer away from them. I stayed with what the odds had curated for me, and it's working. So.
All right. Well, we just we're having problems here. It looked like we were going down to test that pre-market low of 43.40. Only got to 43.42 there, so a little bit of a bounce. Seemed to be getting some good bounces out of this area just early in the session. So that pre-market low area once again just holding up pretty well. Now back in the 43.50 handle. So that little dip and rip there. Once again, so still leaning on that pre-market low here. Look for see if you really want a market turnaround. I agree with Rob here. Look for some of your big boys: Apple, Microsoft, Google, and Amazon, still deep in the red to pose a little bit of recovery. So a little bit overtime here on pre-market prep with StockOdds. I hope we give you some good information. We'll be back with you tomorrow morning, same time, same place. Thanks, Rob. Everyone, have a good day.